So when I go live, what do I, it's automatically live?
I believe you're on. I'm not going to tell you.
Ready? Yeah. You want to go back? Or you want to go? I'll leave it right there. Okay. Good morning to everyone. As our webinar host indicated, your audio and phone lines are on mute, and we will open the lines up at the end of our prepared remarks for questions and answers. During this presentation, you will be able to email us any questions via the webinar hosting service. Please include your phone number with your question that will enable us to contact you if we're unable to answer it during this time frame. Our presentation will run from 10:30 to about 10:45 at the latest, depending on questions and answers. And before I introduce our guest speaker, I'd like to thank our friends at IC Micro, Matt Wett and his crew, for all the work they put up doing this webinar. They've been our IT guys for about 15 years, and we want to thank you for wherever they are for doing this. Without further ado, let me introduce our guest speaker. Corbin Granger is our compliance speaker and our compliance consultant. She is a graduate of the University of Virginia, has earned her PFP from Old Dominion University, and has spent the last 12 years in human benefits in compliance, helping people, our clients, similar to you. Without further ado, Corbin, let me turn it over to you.
All right. Good morning, everyone. You can say good morning to the audience out there. We're talking this morning about healthcare reform, and we have titled it Employer Considerations for 2014 because there is a lot that actually needs to be done this year, or considerations that you need to make in terms of planning for 2014. The biggest change is, as an employer, you've always wrestled with, every year at renewal, trying to provide something that's affordable to your employees and that provides good value, or a term the government uses as minimum value. In 2014, the change is that the government is actually going to set the parameters of what is affordable and what is of minimum value. So I will explain that. In addition, if the coverage that you offer isn't affordable or of minimum value, your employees can, for the first time, go to this entity called an exchange, where they may qualify for an advanced premium tax credit. There are some employees that you will have that would probably do well on the exchange. Some employees may not do quite as well on the exchange, so there's going to be a bit of a push-pull. And today, it's really more of an education, and as Rod indicated earlier, it's something that you really need to follow up an individual conversation with your broker in terms of how you want to approach this with your particular company. So with that said, I bring you to, I hate to call it a disclaimer, but this is a very fast and fluid moving situation. On December 28th, the IRS released 144 pages of rules and regs. They haven't finalized a lot of rules and regs relating to many, many parts of the law. So things are going to continue to change. So we can bring you the information that we know as of today, but just keep in mind, things will change along the way. First, we have an agenda today. I'm going to cover one of the new things in the law. It's called the Summary of Benefits and Coverage that came into effect in 2012. This issue of full-time employees, the definition changes in 2014. We're going to talk about employer coverage, that issue of affordability and minimum value. Then I'm going to touch on the exchanges, the employer penalties. There is some relief there, and just finalized with a couple of issues of taxes and take some questions. All right, summary of benefits and coverage. This is a new provision that came into effect in 2012, and it comes into effect on as your plan year renews. It's a very good provision, actually, because in the past, carriers have always given their own version of events, let's say. Maybe information you got from Anthem was different from what you got from Optima or Aetna. It wasn't communicated in any standardized sort of way. The summary of benefits and coverage is a way to standardize that, and the government actually looked at the Food and Drug Administration labels, and so they created a template. Every insurance carrier uses the template. They create the document. The reason that you need to know about it is you are actually responsible for distributing it to your employees. Your broker will pull it down for you at enrollment and then assist you with giving it out. It goes into effect. It had a, with a lot of things with the law, they don't start the first of the month, but essentially it's in effect for any plan year that started after October 1st of 2012. It goes to people that are eligible for the plan and those that are enrolled. And so the insurance carrier isn't going to know who's eligible but not on your plan. There is a penalty provided for not distributing the summary of benefits and coverage. It can be $1,000 for what they call a willful failure. However, the government has made it very clear in this initial year that there will be no penalties assessed unless you just completely ignore it. So as with most things in this law, they're really interested in compliance and getting people to learn how to distribute the form. So as long as you can show a good faith effort, you would be in compliance. Okay? So the way it would work is, let's say you offer two plans. Maybe you have an HMO and a PPO, and I'm eligible for both, but I'm not enrolled. You would give me the summary of benefits and coverage for both the HMO and the PPO. If I'm enrolled on one particular plan, you give it to me for the plan that I'm enrolled on, which is a little odd because it is open enrollment. It's your opportunity to change plans, but that's how it works. So if I'm eligible, I get it for every plan you offer. If I'm enrolled, I get it for the plan that I'm enrolled in. You can give it in paper, and you can give it in electronic form. If you choose to deliver it electronically, you have to follow what's called the Department of Labor Electronic Disclosure Rules, or their safe harbor. And it's sort of a two-part rule. For people that are eligible but not on your plan, you could actually just post it on the internet, and you can send them like a postcard or an email, tell them where to go to get it. But if somebody is enrolled on the plan, you would just send it to them. They have to be, it's called reasonably calculated to ensure receipt, which means it has to be like an email associated with your work, not a personal email. So if it's a roofing company, you can't send them to people's personal email addresses. If it's an office staff where everybody's in the same building, you may very well choose to use it that way, the electronic disclosure. One other change this year, or it's called the Advance Notice of Benefit Changes. It's called the Summary of Material Modifications. We originally thought this was going to be a pretty big deal. We thought it meant that you would have to, 60 days prior to your renewal, make a change. But that's actually not what it means. What it means is if you make a change off anniversary, you cannot make a change to your plan without giving your employees 60 days notice. So why would that come up? Maybe you're a defense contractor and you've lost a big contract. You don't want to terminate your health plan, but you need to make some changes to it. You can't just change it. The carrier wouldn't allow you to do that. You have to give them 60 days notice. Even if you wanted to make the plan richer, you would also have to give people 60 days notice. W-2 reporting. This currently applies to anybody who issues over 250 W-2s. It is the total amount of the premium, the employer plus the employee portion. Eventually, all employers will be required to comply, but the IRS has said that will only go forward prospectively. If it does apply, it's box 12 using code DDD. Okay, so let's get to this issue of full-time employees. We're going to talk a little bit about full-time employees, waiting periods, and variable and seasonal employees. This is a bit of a complicated area. I could probably talk for about 2 hours on this, so we're going to touch on it, and then as you have specific questions, it may be a good time to have an individual conversation with your broker afterward. But right now, you as an employer get to determine who's full-time, right? Maybe it's 40 hours, maybe it's 35 hours, maybe it's 20 hours. In 2014, the law changes. Anybody who works for you, on average, 30 or more hours a week, is now considered full-time. The eligibility for your health plan also changes. The waiting period for a health plan cannot exceed 90 days. It is not the first of the month following 90 days. So if you have a structure like that, you will need to change it, maybe the first of the month following 60, 30, whatever you want it to be. Okay. You can, because if you are what is considered to be a large employer and you could be subject to a penalty if someone goes to the exchange, you want to establish what's called a look back or a measurement period in 2013 so that you can validate, yes, I've certified that these employees are my full-time employees for my 2014 year, so that you wouldn't be subject to a penalty for someone who went to the exchange. So if you are a large employer over 50, again, that's a conversation you're going to want to have with your broker in terms of establishing some sort of look-back period. The look-back period, this is one of the new rules that came out on December 28th. A lot of companies use a 12-month look-back or measurement period. Recognizing we're already into 2013, they've allowed you for this initial year to use a shorter look-back or measurement period. It has to start no later than July 1st, and it can't end any earlier than 90 days prior to the beginning of your plan year. But again, the concept is so that you can say, during this period of time, these are the people that we know that are full-time, and these are the people that we are going to be offering insurance to. If you have variable hour and seasonal employees, it gets a little tricky, for lack of a better, I believe that's an official term, tricky. So the way it works is, and I think I asked earlier if some people have variable hour employees, and the reason is you know, I work 8:30 to 4:30. So if you hired me, you knew I was going to be 30 hours a week. You knew I would need to come on within 90 days. But let's say it's a restaurant or a bakery, and you don't know how many cakes I'm going to bake. And so you say to me, all right, well, Corbin, we want to offer you health insurance. We just don't know if you're going to average 30 or more hours a week, because sometimes we have a lot of cakes and sometimes we don't. So you actually have the right to measure me. It's called an initial measurement period. It can be a period of time from 3 months as long as 12 months. And if after that period of time I have averaged 30 hours a week or more, you then are required to offer me insurance for a set period of time called a stability period. And this would also apply to seasonal employees. The trick is, let's say you've measured me for a year and you say, Corbin, I'm going to offer you insurance. You're on the plan. Immediately after that, my hours drop. It doesn't matter. I am still guaranteed coverage for you to offer me the coverage for the stability period associated, so for that next 12 months. And you would be required to contribute on my behalf just as you would for any full-time employee. This is why, and along with another reason, is that large employers don't pay penalties for part-time employees, that you have probably, everybody has probably heard in the news of companies cutting people back to under 20, not under 30 hours, so that they don't have to worry about the measuring and also the penalties that apply with the part-time employees. Okay. This rule also applies to seasonal employees. So you would want to set up your measurement period either, and it depends what you want to do, to either include seasonal or exclude seasonal. But again, that's a conversation that you'd want to have with your broker to see how it applies to your particular plan. You can also, after you have measured me and determined that I'm eligible for the plan, you obviously need to enroll me. So the government gives you a period of time to put me on the plan. If you've measured me for 12 months, you then can't have another 90 days to enroll me. You have to put me in on the plan within 13 months plus a fraction. But they do accommodate a period of time for you to enroll me. So if I fail to turn in my enrollment form to you or whatever, you were not liable in that particular situation. Okay, so I talked a little bit, or I mentioned this issue of affordable and minimum value coverage. Just to get a show of hands, who's heard of the 9.5%? Okay. So this is a big issue because, as you said, I know that you struggle every year to try to bring something that's affordable and of good value. But now, in 2014, the rule is going to be defined by this affordability test. But let me go over minimum value first because it's a little easier. Minimum value is the government says you have to offer a plan that provides at least a set minimum value. And they typically use the term actuarial value. It's linked to that term, which means it has to cover about 60% of the cost of the total benefits on the plan. So what do I mean? Let's say we're all on a 60% actuarial value plan. Greg, you go to the doctor. I go to the doctor. Rick, you go to the doctor. The plan's going to cover roughly 60%, and we're going to be responsible for 40%. So that's all it means. It really just kind of means that average. You really don't have to worry about the minimum value because the insurance carrier is going to calculate that and make sure that it meets those standards. So they're not going to give you a product that you couldn't use for your employees to meet that standard. But that's what it is. And again, it's based on that term called actuarial value that crops up when I talk about the exchanges. So the issue of affordability is very specific, and I'm going to spend a few minutes on it. Affordable coverage refers only to the cost to cover the employee on the lowest cost option you offer. So if you offer an HMO and a PPO, you would look and see if the plan was affordable to the employee, in this case, let's use me, on the HMO. Okay? The regulations actually say it can't exceed my share of the premium to cover myself, cannot exceed 9.5% of my household income. How many of you know your household income of your employees? Right. So the IRS created what they call 3 safe harbors for the affordability. You can look at 9.5% of my Box 1 W-2 income. And Box 1 is significant because that is taxable compensation. So if I work for you and maybe I'm making $40,000 a year, but I'm putting $2,000 in my flex plan pre-tax, that is not included. So you would have to exclude the pre-tax contributions. The other safe harbor you could use is you could take, because some people pay hourly rates, so you could take the hourly rate, multiply it times 130 hours, and get 9.5% of that. 130. So as an example, I took minimum wage, and I think 9.5% for that was a little over like $88 or $89. So that would be affordable at that age base. You could also use a safe harbor of the federal poverty level. We don't have the one for 2014 yet, but it's I think it's 11,170 this year. So you could take 9.5% of that, which is also close to $88 or $89. Okay. So yes.
What happens if it's a couple, married or unmarried, that are, have families and stuff like that? Do you have to do it for each? What happens if both employees work for you?
It's just the cost. It would just be the cost to cover the employee, right? So essentially, if you're looking at the box 1 income of your lowest paid person and it doesn't exceed 9.5% of that, then you're clear for the group. Yeah. Now, the affordability test creates another interesting scenario, though, because remember, the premium's only based on me. So what if I have kids, or what if I'm married? So the IRS has created some rules for that, because we always have rules when it comes to that. But the idea is that it is dependents under the age of 26. Strictly for this law, dependents are considered children under the age of 26 and not your spouse. Why would that be? Okay, let's say I work for you, and in 2014, we'll just make it simple, you pay 100% of the cost for me on the HMO. You just, clearly that's affordable, correct? Right? Okay. But I have 2 kids. So in order to insure these kids, I'm going to have to buy up or pay for them. And maybe that's $800 a month. Maybe that's truly, in reality, not affordable to me. It doesn't matter. Under the law, the employers offered me affordable coverage. If the employer is a large employer, they're not subject to a penalty. And my children, my dependents, are not allowed to seek exchange credits or subsidies through the exchange. Okay. They have excluded spouses from this dependent definition, so the spouse could go to the exchange, because in a minute I'm going to show you the exchange and show you how the subsidies work. So another example, I'm married. I've always had my husband on the plan, but again, in 2014, the calculation changes. They pay 100% for me on the HMO, and they actually do not offer coverage to my spouse. And why would they not do that? Because if they offered coverage to my spouse would be blocked from going to the exchange. So, I see some people. Is that clear to everyone?
2014, your insurance. In 2014, and please jump in on this, Corbin, when you offer your group health plan, you will have the opportunity to not offer health insurance to the employee's spouse, only their dependents, their children. And this makes the spouse eligible to go to the exchange. It could cause a lot of upheaval within the ranks, but that is part of the new law that's coming into effect in 2014.
Yeah. And originally, I'll tell you, the original rules were even more restrictive. The spouse wasn't allowed to go to the exchange. So this change just came down to allow some flexibility. Did you have a question?
Children will still be, they don't have to exchange.
Yeah, the question from the audience is, can the children go to the exchange? And the answer is, if you, the employer, are offering affordable coverage to me, they will not be allowed to go to the exchange. If you don't offer affordable coverage to me, then both I and my children could go to the exchange. So it's a very different way of thinking about it. Yes? Only if you're over. The question was, if we don't offer insurance, are we penalized? And the answer is, if you are over 50 full-time employees or equivalents, you are subject to the penalty. If you, yeah.
We'll get into that in about 4 slides.
And I think a lot of times we spend a lot of time talking about the penalty, which I know applies to many of you in this room. But even if the penalty doesn't apply, if you are a small employer, the issue of affordability and minimum value still do apply. And so you may have some, again, you may have 5 highly compensated employees who are not going to get any exchange subsidy, and maybe 5 minimum wage people who would clearly do better in the exchange. So one of the hypotheticals that's been running around is it possible to make a plan actually for a small employer unaffordable, so you could maintain the group coverage for people who wouldn't get any subsidy, but allow people who would qualify for subsidy to go to the exchange. That is, and that's one of the things, that's one of the questions I bring to the table. That's one of the things that your broker will talk to you about, because we haven't actually gotten all the answers from the insurance carriers yet. Will exchange eligibility be considered their coverage, because you do have participation requirements that you have to meet on the insurance. So I've mentioned this exchange. Yes?
I'm sorry, are you saying that if you do offer your spouse or spousal coverage, that they can't go to the exchange? So it's either you go for the coverage or you go to the exchange, but there's no decision one way or the other. It's whatever we decide.
Yep. The question is, if I offer as an employer spousal coverage, is the spouse eligible to go to the exchange? And if you offer spousal coverage, then yes, the employee spouse would be blocked from exchange coverage. So it's simply the offer, not what they do. If they choose not to go to the exchange, they would be subject to the individual mandate and that penalty. From your perspective, it's just what you're offering. All right, so this exchange, what is it? Well, it's a marketplace. It's sort of, they sell it like it's a mall. How many people shop online? I know more people. So, much like I go online to Zappos.com and there's a pair of shoes that I might like and I put them in my bucket and I purchase them, that's the idea here, is that if I qualify for exchange coverage, I will be able to go to this exchange. It will have a real brick and mortar location, but they envision most of the interaction to be online. The state of Virginia has elected not to create its own state exchange initially. You can have a federal exchange for a number of years prior to the state taking it over. So we will be having a federal exchange. I have heard, though I haven't seen the regulations, that you can also, businesses under 50 will be able to go into this exchange, though the regulations go up to 100. But the word on the street right now is that it's up to 50. So how would it work? First of all, I would have to see if I would either, to be eligible for exchange coverage, I would either not have to be offered coverage at work, or the coverage that is offered to me is not affordable or of minimum value. So let's assume that's the case. I work for ABC Company. They drop the health plan. They do not offer coverage. I type in my name on the computer, Corbin Granger. It pulls me up. It's going to say, Corbin Granger, we see you work for ABC Company. We see they don't offer health insurance. You make X amount of money, which is based on household income on the exchange, not my box 1 income. We see you make X amount of money. You qualify for Medicaid, or you qualify for a subsidy. Here is the subsidy. Here are the plans. The plans are all going to be provided by private insurance carriers. So it's not a public option. But you can see it's going to have to integrate with the IRS, with HHS, Homeland Security, Department of Labor, and with all the health carriers that are qualified to sell the plans within the state. The other trick is this exchange has to be up and ready to accept enrollment by October 1 of this year. Yeah.
That's the joke.
That's the joke. You hear those, that big jet that just came out, that big 757, yeah, the Dreamliner, and sold as a big luxury. And so sort of think of the exchange as sort of, it's going to be a supersonic, seamless experience. And, in my mind, sometimes I think a little more like rickshaw kind of thing. You'll still get there, but they'll have the guy pedaling you along the way. So it will be interesting, initially to see how this works. We as brokers will be able to interact with the exchange. So whether your broker is helping your employees interact with the exchange, or you as a group interact with the exchange, or you decide to stay out of the exchange altogether, your broker is still committed to working through this process. Does anybody have a question? Yes.
Sorry, my question is, who is in charge of putting all the information to the exchange as the employer? Would it be Rod, per se, because he's my rep, or would it be the company to go in and put in, let's say, you, who doesn't qualify or doesn't want it to go into the marketplace?
Right. The question is, how is the information to the exchange reported? And there will be employer reporting required of large employers. The first return will be due by July 31st. Health insurance issuers will also be required to report. So there's built into this law, there's a lot more record keeping and reporting on behalf of everyone in order to make this engine run, so to speak. So thank you. That was a great question. They use the example of Medicare.gov. It's the same kind of thing. You know, if you go to Medicare.gov, it has every answer in the world. Unfortunately, that's also part of the problem. It has every answer in the world, and you need to know where to go to find it. So again, your broker is committed to helping you navigate this exchange. And we haven't seen the exchange model yet. So it's, you know, as I said, still fluid. All right, the exchange is going to work on that concept of actuarial value, and they chose a term called metallics. So a 60% plan is called a bronze. That's the minimum level plan that they can sell. You can purchase a silver at 70, a gold at 80, or a platinum at 90%. Or if you're under 30, you can get a young and invincible product. Your subsidy, should you qualify, will be based on the second lowest cost silver option, which is sort of a mouthful. But it's not going to be called that. It's going to have, you know, different names associated with it. If anybody's familiar with like Medicare supplement plans, they have to have certain underlying benefits. It's like A through J plans. They're not called that, but the underlying value is still going to be the same. Yes. The question was, are the exchange plans family or individual? They are both individual and family. And I'll have an example of what the subsidy is on the employee level and also what the subsidy is on the government side. So one of the other things is it turns out about 70% of people who are going to benefit from exchange eligibility aren't aware of it. So you, the employer, are required to give a notice to let people know of the existence of the exchange. The rule exists. The regulation has not yet been written. This is supposed to go out by March 1, but we don't have it yet. When it comes, it's going to say, you know, this exchange exists, that you as an employee may qualify for government subsidy, and you, the employer, may not give them any money towards the cost of the coverage. So I wanted to include some examples of actuarial value plans in here. So I've given you two bronze plans, and these are just hypotheticals. You can see the deductible differs by $500, 20% to, and then it's got 20% to 40% coinsurance. Takes you to that same $6,250 out-of-pocket limit. If anybody's wondering where that number came from, that's the HSA out-of-pocket limit. Silver plan, is a little richer. So here you've got two different ones, one with a $1,500 deductible, one with $1,250, versus a 15% coinsurance or 20%, and it takes you to a little richer out-of-pocket limit. So that's the underlying model of the plan.
This is the one that changed.
Yes. Anybody who's qualified to sell, so like in the state of Virginia, Optima or Anthem, they have to create a plan. They have an actuarial value calculator that HHS put out, and it has to meet that actuarial value, and then it's certified to sell in the exchange. The huge attraction for the exchange are the subsidies. They call this the Affordable Care Act, And what really makes this affordable are the subsidies. Because if you qualify for a subsidy based upon your income, you could get a very generous subsidy from the government. So about 20 million households, and this is a little bit of an older statistic. I think it's going to be higher now that they've changed the offering of the spousal coverage in December. But originally it was envisioned for anyone between 133 to 400% of federal poverty level could qualify for a subsidy on the exchange. I don't know how much you kept up with the Supreme Court issue, but the idea was anybody below 133% of federal poverty level was going to be on Medicaid. And that was the part that the Supreme Court said is not constitutional. So now it's going to be people between 100 to 400% of federal poverty level, you can be exchange eligible. Virginia is not expanding Medicaid. Some states may choose to, but Virginia is not choosing to expand Medicaid. So what is poverty level? To give you an idea, and we don't have 2014 numbers, but to give you an idea, 400% of federal poverty is a little over $44,000. So if I make $44,000, I qualify for a subsidy. I make $45,000, I'm out. No subsidy. Maybe I'm a family of 4. I make $92,000, I'm in. I make $93,000, I'm out. So you can see you're going to have some employees who may do very well on the exchange because they would qualify for a subsidy. Or you're going to have some employees who would qualify, they would not qualify for a subsidy at all. And that is one of the things that you're going to have to think about as you work with your broker. In addition, the maximum amount that you can pay towards this coverage is linked to your income. It's not linked to the cost of the health plan. So, and it's a sliding scale determined the most you would pay for your coverage should you qualify at 400% of federal poverty is 9.8% of your income. So let's say I'm married, I'm doing pretty well, we got a family of 4, we're making what, 92, we pay 9.5% of our income, so a little over $8,700 for coverage on the exchange. Okay, that is not a bad deal considering the cost of coverage sometimes for a family of 4 is upwards of over $20,000. So you could see it could be attractive to certain families. Let's say I'm not doing quite as well. I'm at 133% of federal poverty level, same family, same coverage, same plan. I'm paying a little over $1,200 for the cost of the coverage. And I use this joke that if I really didn't marry well and I'm at 100% of poverty, family of 4, the most we would pay is $461.
That's a year, correct?
Yes, a year. Of course, I would argue if you're at 100% of federal poverty and trying to support 4 people on that, you got a lot bigger problems than coming up with the calculation, coming up with the subsidy for the exchange coverage. And even though I would be subject to the individual mandate, it's only recoverable in the event that I get a refund. So it can't be, I can't be penalized. It can only be taken from a refund that I'm due. There's no interest that can accrue on it or seizure or lien or anything like that. Okay. Yes? The question is, can anybody be denied for pre-existing conditions? And the answer is no. One of the great things about the law is in 2014, all pre-existing conditions go away. The only thing you will be rated on is your age, where you live, how many people in your family you're applying for coverage for, and whether or not you smoke. Okay. So that is one of the good, that is part of the good news, I think, of this law. So I've given you kind of a snapshot of what you, the employee, would pay. So let's look at the subsidy level from the government standpoint. This comes from Kaiser, actually. They have a healthcare reform calculator that they've put together. So in this instance, I'm 53. I'm making $71,000. We're a little over 300% of federal poverty, which gets us in that 9.5 range. So we pay $6,700, and the government pays $11,000. On this one, I've aged off my parents' plan. I'm 27. I'm making $25,000. I'm at 200% of federal poverty. So here I'm going to pay 6.9% of my income, or $1,700, and the government pays a little over $1,600. So that's how the exchange will work. Initially, the open enrollment will be a little longer, but after the first year, the exchange open enrollment is going to be linked to the Medicare open enrollment. I think it's going to be the same time period. So that's going to be an interesting couple of weeks for everyone. All right. Does anybody have a question? Okay. So let's say you're a business. You can go into the exchange if you're a business, if you're of a certain size. As I said, I've heard in Virginia it's going to be up to 50 employees. And one of the things they're really concerned about, because there's no pre-existing conditions in 2014, you're going to have people, and people are going to get subsidies. You're going to have a lot of people going into the exchange who have not had coverage in a while, who may be sick. So they're concerned about adverse selection. So part of keeping the number down helps with that. But let's say you go into the exchange as a business, right? And again, this is another hypothetical situation because we haven't seen all of the rules. But you could go in just as a business. ABC company could go in and purchase exchange coverage through there as a shop. You could say perhaps you've had some people that haven't been happy. You've been with Anthem, and maybe I haven't been happy with the Anthem network, and some other people haven't been happy with the Anthem network. And so you might say, you know what, we're just going to give each of you a set amount of money, like $500, and you can go purchase your own coverage from the exchange. It's possible. This could be done through what's called an HRA, or a health reimbursement account. You could pre-tax it, so you could pre-tax it on your end. The employee could receive the pre-tax as well. Okay, that is a hypothetical. It's based on a couple of things, but that's an idea of how the shop may work. You may choose to stay outside of the exchange altogether. Anybody have a question? As I said, one of the reasons the exchange is going to know who I am, where I work, how much money I make, is because employers are going to give them information, going to tell them what the waiting period is, how many people are in coverage, what's the lowest cost option, and they're going to cross-check all of this. It's going to be very interesting to see how this works. This will be effective for 2014, but the first reporting period is going to be 2015. So let's get to, yes. Yes. Well, I wish I knew. And, yeah, no. And the question was the exchanges have to be up and running by 2014, but the lag time for the reporting and the penalties is 2015. How is that going to work? And the answer is we don't completely know. We do know, however, and I'm going to get into this in a minute with the penalties. Let's say you're an employer that you're subject to the penalty. The penalties, 2014 is the first year this is going to apply. The IRS is going to take everybody's individual tax returns, so they're going to wait until everybody's filed their tax returns. With extensions and everything, that's until October 15th of 2015. And then at that point in time, they will notify you if you are responsible for a penalty. You then have the opportunity to respond, and then you either pay the penalty or whatever happens back and forth. So you could actually be paying a penalty for an employee who no longer works for you.
One question. I think you said that, right now I'm with Optima. If I decide to go through the exchange, I still could be with Optima. It's just, okay.
You could be with Optima. The way they set up the exchange, you could be with Optima. Anyway, but you also could be with Anthem, Cigna, Aetna. When, like Corbin said, when you give that flat fee of dollar amount to the employees, basically you're just washing your hands and saying, hey, I'm giving you $300. If you want an Optima HMO, you can have it. If you want an Anthem PPO, you can have it. If you want a Cigna plan, whoever is in that exchange, the employee is going to have the ability to sign up on. So if you, like Corbin said, if you have an employee that's been constantly upset about not having their doctor in the network, your hands are now washed because they can go to whatever network they want within that plan and sign up there. Now the big question, of course, is who is going to instruct them and help them go through these plans.
All right, so let's say you're a large employer, over 50 full-time employees. The first thing you have to do is there are penalties in this situation. So the law applies to everyone. The affordability test and the minimum value test applies to everyone. But if you're of a certain size, the government says we have the right to penalize you if you do not meet these requirements. So they look at the preceding calendar year. So to calculate whether you are a large employer or not, you're going to be looking at your calendar year of 2013. And if you qualify, you would be, you could be penalized if you chose not to offer coverage, or the technical term is not offering it to 95% of employees independent, or the coverage is not affordable or of minimum value. The first thing you have to do is decide, am I a large employer? And this can get a little tricky because you have to include your part-time and your seasonal people in your calculation. And your broker is supplied with the large employer penalty calculator to help you calculate whether or not you're a large employer for each month. But the way it works is you would take from January to December of 2013, and for each month you add up your full-time people. All right? You then take your part-time hours, everybody working part-time, divide it by 120. You include your seasonal people in both your full-time and your part-time hour count. You then create a total for that month. After all 12 months are done, you then divide that by 12 to come up with your average. If your average is over 50, you're considered a large employer. If it's under, you are not considered a large employer. If it's seasonal employees that kicked you over, if you're considered a large employer, you then get to check and see if it's the seasonal ones that kicked you over, and you can back them out. Seasonal for this purpose is individuals working 120 calendar days or less. Yes?
Clarify real quick. For 120 days for seasonal people, if they are seasonal with 160 days, we would then have to go back to the original calculation.
Yep, the question is their definition of seasonal is 160 versus 120. And for purposes of the large employer penalty, it's 120 calendar days. They do not have to be consecutive. So you could have maybe a store where you have some seasonal people in Christmas, or, and some in the summer. For 2013, and this is one of the new rules that came out, if you are close but not sure if you're over 50, because you can see a number of restaurants, retail stores, there are a lot of businesses that qualify as a large employer. They may have a small core full-time staff but a large part-time staff. If you're close, you can actually choose any 6-month consecutive period that you want in 2013. So it kind of allows you some wiggle room. You don't have to look at the full 12 months. You can choose any 6-month period you want to determine if you're a large employer for 2014. Okay. So the example the IRS gives is January through June 30th. That way, if you have a lot of part-time people during certain periods of the year, maybe the summer, you could exclude them. That's a one-time gift that they're giving you.
Temporary employees.
Yeah, the question was regarding temporary employees. Temporary employees, that's a fantastic question. And do you mean temporary in terms of like they're working for a staffing agency? Right now, if they're working for a staffing agency, in general, they're considered employees of that staffing agency. Yeah. And that creates a multitude of problems for the staffing agency, obviously, because they have people that go on and off all the time. And the IRS is developing a separate set of rules for them. So, but in the meantime, we all have to keep moving ahead without knowing what the ground looks like. So. All right, big question, big issue was, how many people here don't have a calendar year plan? Your health insurance renews. Okay, if you are a large employer, you could be subject to a penalty as of January 1, right? However, the IRS has said that if you are a large employer, you will not be subject to the penalty until your plan year renews, as long as when your plan year renews, you make it affordable or of minimum value. We were all worried out there that people were going to have to scramble and change their plans mid-year, but the government came out and said, in general, no, you do not have to worry about that. You're really looking at a plan year renewal. So let's just show you how the penalties work. The first penalty is called not offering coverage, or not offering coverage to 95% of your employees and dependents. You never ever pay a penalty for a part-time employee. So though part-time employees are included in your count to see if you're subject to the penalty, you will not pay a penalty for any part-time employee who goes to the exchange. The way this penalty works is you could actually be a large employer and drop your coverage, not offer coverage, and not pay any penalty at all. And the reason is someone has to go to the exchange and get a tax credit. Once that happens, that kicks off the penalty calculation to you, the employer. So if I work for ABC Company and they drop their plan in 2014 and I go to the exchange and get a tax credit and they're a large employer, they would be then subject to the penalty. The penalty for the not offering coverage is $2,000 per full-time employee, because you don't pay penalties on part-timers, and you get to deduct the first 30. So we've given you a little example. It's 70 employees minus 30. And here it's an $80,000 penalty. Please keep in mind this is non-deductible and this will be indexed for medical inflation. And medical inflation has been kept low, but it is about to skyrocket in the next couple of years as healthcare reform comes into play. And as the government is looking for money, and this is strictly just my opinion, but the penalties are a way to achieve that. There are controlled group rules. If the government can make you bigger, they will. So if you have common ownership and they're looking at the retirement rules, it's section 414. If you're a member of a controlled group, you actually have to share your 30 employees. So if you have Company A and Company B and they both drop their health plan, Company A can deduct 15 employees and Company B can deduct 15 employees. There are a number of other different scenarios that could work. You could actually have Company A keep their health plan, keep it affordable and of minimum value and not pay a penalty, and Company B maybe drop their health plan and pay a penalty, but they would only deduct the 15 employees. That's something you'd want to talk to your broker about. Do we have a question? Okay. Affordable. I know we've been kicking around this term. Just as a quiz, what is affordable? Box 1. Yes, thank you. Yes, sir. Sure. Okay, the question was if you have less than 50 employees, and that's a great question. There's absolutely no penalty under the law for less than 50 employees. However, if your coverage is not affordable or of minimum value, I could go to the exchange. There is no penalty for anyone going onto the exchange if you are under 50 employees.
If you're under 50 employees and you offer an affordable and minimum value plan, and the employee refuses to accept the insurance, are they eligible to go to the exchange at that point?
Okay, this is a really great question. The issue was if you're over 50 employees, under 50 employees, and you offer affordable coverage of minimum value and the employee refuses it, are they eligible for the exchange? The answer is no. It's your offer of coverage that determines everything. So the government is going to look first at, is the employee being offered something that's affordable and of minimum value? If that is occurring, the employee is not allowed to go to the exchange, and the dependents are not allowed to go to the exchange. And dependents under the law for only this purpose are children under the age of 26, not the spouse. So some employers may choose not to offer coverage to the spouse so that the spouse can seek an exchange eligible plan and qualify for a subsidy.
If they do not accept the coverage, are the employees then subject to a penalty for not having insurance?
Yeah, there's another great question. If they do not accept the coverage, are the employees subject to the penalty? And the answer is yes. If someone, it's up to the individual to take the coverage. The only thing that applies to you is the actual offer of coverage. So if I worked for you and I said, I'm not taking the plan, I am then subject to the individual mandate, that penalty, which is in 2014 $95 or 1% of income, and of course it goes up each year. But from your perspective, it's simply the offer of coverage. Thank you. Okay, so affordable coverage. If you offer coverage, but it's not affordable, it doesn't fall within those parameters, you can be penalized if you are a large employer. Again, $3,000 for every employee who goes to the exchange and gets a subsidy, or $2,000 per every employee minus the first 30, whichever is less. So, and again, you still never pay. I say this a lot because it comes up, is that you don't pay a penalty for part-time employees. There's a safe harbor rule. This applies. There are certain companies out there that were just offering coverage to the employees and not the dependents, as long as you can show that you're offering coverage toward the dependents. In 2014 for 2015, there's no penalty. There's also an additional safe harbor in that, let's say the government realizes you intend to offer coverage to somebody, but maybe there's a mix-up, they don't get enrolled. As long as you can show that you're offering coverage to 95% of your employees and dependents, you won't be penalized. It's what they call a safe harbor. Cafeteria plan rules can come into play because, how many people here have cafeteria plans where you allow people to take out their premiums pre-tax? Okay. Well, exchange eligibility, your coverage not being affordable or of minimum value is not a change of status under a cafeteria plan. So someone could actually be eligible for exchange coverage, but they wouldn't be allowed to stop their cafeteria plan reduction for the premiums. So the government has made what's called a one-time change. It's sort of a one-time hop-on, hop-off provision, but you do have to amend your plan document to allow that. So in 2013, you can prospectively revoke or change it related to the insurance, so people can't change it with their FSA accounts. And again, if they have an elected coverage, they can opt on. But you have to amend your plan to do that. So, that brings up the pay or play, which is better. And again, that's a, you know, I'm giving you the world view here, and you really have to look individually at, for each company, you know, look at your full-time employees, look at your salaries, look at the penalty. I mean, your broker can help you calculate all of that. Are you a large employer? What would your penalty be? If you're under 50, what would you want to do to keep it affordable and of minimum value? These are all things that your broker is working with you on. We don't have every answer yet, and the government doesn't have every answer. But with every challenge, hopefully comes opportunity. So, you know, whether it's assisting your clients, your employees through the exchange as individuals or as a group, it's still the same issue of benefits. And I think, you know, I like to ask people, why do they offer benefits today? Yeah, and the answer was to retain better employees. And I don't think that reason has gone away. So, you know, hopefully this is something that, I hope that this has been educational prospect for you. And I believe we are at the question area, and we're not at the question area yet. We're at the planning considerations, which is, these are issues about the HRA and the fees. I need to discuss those in a minute. Is your plan of affordable and minimum value? Are you a large employer? There's a couple of last issues with taxes. We all know the Medicare tax. Oh, excuse me. Walter?
With us today is our CFO, Walter Berry, who has had a private practice for 30 years, taught as a professor at Old Dominion University for that equal amount of time, and recently, which we're very proud of, has been named by Business Virginia as one of the top 5 accountants in the state. And he is our CFO, and with that, I will let Walter take over on all the new taxes. And Walter also will be available to any of our people during this time frame as well.
Thanks, Rod. Wasn't top 5. You can fool some of the people some of the time is what it really works down to. And here, after you're so excited now, they put the accountant on the end to damper it all down, calm you all down. And as Rod said, I was a faculty member at Old Dominion for 30 years, and I'm sure that all of you probably had a class somewhere where the professor, all they did was read the book, so I'm going to get the act out now, all 960 pages, and just read it to you. And no, I'm not. That's what it tells. Yeah. Anyway, as you can see on the screen, the taxes that have come out, because they have to pay for this money that they're giving everybody in the exchanges as the premium credit or the subsidy, if you want. All this has to be paid for somehow. They started out in 10 with the new tanning tax, which was 10% on the fees that people paid to get a tan at a tanning salon. And that went in. And you can see on the slide in the billions of dollars of revenue that this supposedly was supposed to generate. And then they have it on name brand pharmaceuticals that started in 2011. In 2012, they have it on medical device manufacturers are now going to have to pay a fee on every medical device that they manufacture. In fact, I'd heard some anecdotal stories about smaller firms that were doing specialty things here that were probably just going to go out of business because they didn't feel like they could compete and pass the cost along to their customers. But anyway, that's another story. The ones that really affect us and a lot of people are the ones that are coming into play in 2013. And the big one there is the additional Medicare tax on people of income, single 200,000, and for married filing jointly 250,000. You're going to pay an additional 0.9% Medicare tax, which you all know is a non-deductible tax. And additionally, also there will be 3.8% additional Medicare tax that will be assessed on individuals on their net investment income on their returns at the same income levels. And these will be calculated on your tax return, the 3.8% for an individual, and will be remitted. I will tell you this, there is no mechanism, if you're a working person, there is no mechanism for you to have that withheld as separate Medicare tax. All right, the only way that you can do it is to increase your federal withholding tax if you think that you're going to be subject to it, or you have to pay estimated taxes to take care of it. It's something you can discuss with your individual tax advisor. The 0.9% won't kick in on your earnings until your earnings for the year go over that amount, and there's no way for your employer to factor in that, okay, I work and I make this much, and my spouse works and they make this much, and so we're going to get hit with this, and how do we pay it in, etc. There is no mechanism for this. In other words, if you're going to have to pay extra tax under these provisions, you're going to have extra withholding tax done. So it's something you're going to have to figure out prospectively, or at least maybe your accountants will after they work on your taxes this year. A couple of things that I wanted to just point out specifically. Corbin talked earlier about the control group status. Control group, for those of you that are members of control groups and know about this, you've known about this from a tax standpoint for a number of years. Your tax people have, done the returns, et cetera, be you parent subsidiary, be you brother sister, be you a member of a combined group. There's a series of rules that do this, and so it's for the same reason why they did it in the first place from a tax standpoint, and that was you couldn't set up all these little bitty corporations and everybody have little cheap tax rates when altogether you were actually supposed to be in the 35% corporate rate. And so Congress picked up on that really quickly years ago and said, no, you got common ownership. We don't care if you have 47 corporations. You're only going to be able to pay the lower rates in one bracket, and you get to divvy it up however you decide. We're going to do the same thing here. It's not going to be you can have one company with X employees and this employees and this employees, and you own all of them, and then you can go, oh, well, I don't have 50 employees because none of these companies has more than 10, but I have 75 companies. So they're going to beat you. You can't run from it. So control group is going to be an issue here when you're thinking about making the measurements of whether or not you're a large employer or not. Additionally, she pointed out that the penalties, if you have to pay penalties in this, do you want to pay or play? And what they're talking about there, everybody, is, okay, I'm not doing coverage. I'll just pay the penalties. Penalties are non-tax deductible, which means that when you start figuring out, well, it's going to be cheaper for me to just not have coverage and just go do whatever you're going to do, and we're going to pay the penalties. That you remember that you got to factor in how much money do we have to make so we can pay the income taxes, so then we can pay the penalties. So that's going to be a little more involved process in making that decision about whether or not you want to just say, scrap it all, I'm tired of government regulation and I just want to pay the penalties and be done with it. She also pointed out that none of this is going to take place till everybody's filed their tax returns, and you know that individuals can extend their returns till October the 15th. So then they've got to be able to crunch all that data from wherever they're going to get all this data, and they're going to get data. And I noticed on the one slide where they were listing all the stuff that you have to report, and then the last line says, and any other information they determine they want. So that, which hasn't been decided upon yet, but I'm going to guess that they're going to just want tons of more stuff, which means more reporting for us. Additionally, the last couple of things I wanted to mention were on an individual basis that starting in 2013, for those of you that file your individual income taxes and you have ever taken a medical expense deduction, it's your out-of-pocket less 7.5% of your adjusted gross income before you got it as part of your itemized deductions. That's been increased to 10%, so that reduces the amount of itemized deductions, meaning taxable income goes up so they can get more income taxes that way. And secondly, the flexible spending account max is now $2,500 starting this year. So they did that. It was at $5,000 as a max, and then, or most people would set it as a max of $5,000. And for a while there, for a number of years, you could do over-the-counter products that were medically related could be reimbursed. They cut that out, and now what they have done is they put a max on it of $2,500 per employee per year. So you have a lot going on here. You will notice that coming along there's going to be additional fees on the insurers, and in 2018, which is a way out, and of course things may change by then, but you're going to see an excise tax on high cost, which they refer to as Cadillac plans, which I'm sure the Lincoln people probably are not happy about all of that. Well, there you go. And this is just a little slide that shows what's going to be the impact on various types of policies because of these insurer fees that the insurance companies have to pay, and you can bet that they're going to pass them right on through their premiums. And you can just look through that. And then last but not least, this is fairly narrow in scope, and that is if you have an HRA plan, health reimbursement account that you have set up, this law considers them separate plans. And unbeknownst to a lot of people, that if you have a plan year ending on or after October 1st, so what it said was the law says after September 30th, 12, all right, you are now subject to an excise tax on that plan based on the number of lives. And you will see here that we've got here that's $1 employee, and then it's $2, and then it can be whatever they want for a number of years. And this is to fund research, all right? And this is an annual form that you're now going to have to file, which is a 720, which is the excise tax form, and everything on the form shows you that it's a quarterly filing, but for this you only have to do it annually. It's due by July 31st of next year. So if you have an HRA, this is something you're going to have to take a look at to see this. I will tell you that as of this morning, I looked at the latest issue, the 720. This is not even addressed on it, but IRS is promising that they're working on it and that they're going to get it figured out where it's going to go on the return and update their instructions for it. So here you go. So if you have that, that's something you need to talk to your tax people about. All right, and let's see. Corbin's back, so thank you.
Thank you, Walter. We're going to now open it up to some questions and answers. As we've been promoting this webinar, we have been encouraging people to send in some questions ahead of time, and we've included in the packet of information slides some of these very good questions that have come in. So Corbin's going to address a couple of these, and then we have some more that have come in during the webinar. So we'll get to as many as we can in the next 18 minutes. Thank you. Here's Corbin.
Okay, this is a good question. It talks about how the premiums are going to be affected, about premiums soaring beginning with renewals. And, you know, it really kind of depends on who you are. Remember, pre-existing conditions are going to go away, so you're only going to be rated on your age, where you live, whether or not you smoke, and how many people you're applying for coverage for. Also, there's going to be what's called a compression of the rates, because right now with age rating, it's closer to a 10-to-1 ratio. So if you're younger, and it's going to compress to more of a 3-to-1. So if you're younger and healthier, your premiums are going to go up, which is bad news. If you are older and sicker, your premiums are going to go down, and it's going to be sort of a meeting in the middle. In addition, health plans of a certain size have to cover these things called essential health benefits on an unlimited basis. They have yet to actually determine what those benefits are going to be, but we have that in the law too. And there is no pre-existing. What regulations have been imposed? Again, there's no pre-existing. Annual increases. The insurance companies have to provide, they have to use the MLR, which means 80 cents every dollar they collect in, I believe it's a small group, 80 cents on that dollar has to be used for claims, and only 20% can be used for expenses. If a company has an unreasonable rate increase, it actually has to be put on the state, I believe it's the healthcare.gov site. They actually can't determine, can't make them change the rate increase, but if the state deems it unreasonable, then it will be posted there. and your own personal health really will no longer be an issue because there is no pre-existing conditions, with the exception, the only health factor that would be rated in is whether or not you smoke. Yeah.
I'll let you say it because I'll let you talk about it better. But when we're talking about, someone asked about rates, and like Corbin said, 50%. There is one other article that must be considered, and I know we've talked about it with many people, and that's wellness. And with the new law, a wellness program differentiates some premiums. And I'll let Corbin take it from there.
Well, it means you can give a premium discount of up to 30% for your employees for participating in a wellness program. So that is some welcome news. It doesn't affect your underlying rates, obviously, because you're not rated on the health of the group anymore, but you can promote wellness. You know what? We have a wellness program, and it's amazing when you have someone in charge of it, how it can really take off. And it's something that's actually built into all of your plans. If you have your carrier, wellness is incorporated into it. So it's something that you probably want to consider. I want to also address here, it talks about, somebody's talking about affordable coverage for a self-employed individual who's suffered a catastrophic event. Again, there will be no individual health underwriting for that person, but that person could, based upon their income, qualify for an exchange subsidy. So that's how the difference could come in there. And this company has 27 full-time employees, myself, wife, and 2 sons. Participation is low. There are no penalties under 50 full-time employees. However, the coverage would need to be affordable and of minimum value, or the employees would be eligible for exchange coverage. Can you maintain your current positions? I'm sure you can. That's all dependent upon what the plans look like. Remember, the carriers are all going to be the same. It's going to be Anthem and Optima and all the different carriers. So it's just depending on what the networks look like. And we don't know what the plans look like yet. So, yeah, 30 hours a week. Again, that's no longer up to your discretion. So it's 30 hours a week on average. If people are variable hour employees, you are going to be required to measure them to see if they meet that 30-hour threshold if you're a large employer. Mental health benefits, again, I referred to, and I didn't talk about this today because this is a completely different conversation, but part of the law was, you know, if you have maybe an HMO versus a PPO, you couldn't necessarily guarantee that you had the same type of benefits, or if you had a catastrophic illness or an event, you know how you could reach a lifetime cap and no longer have insurance? Well, they addressed that in this concept called essential health benefits. And the idea was the government's going to say there are certain benefits that we consider so important for people to have that we are not going to limit them in terms of the amount of money that the insurance company, your benefits for these essential health benefits. They came up with a category of 10 benefits. They tried for 2 years to put together a list of benefits that were comprehensive but not cost prohibitive, and they couldn't do it. So then they've sent it to each state. Each state now has to define what they consider essential. Mental health is one of those categories. So mental health would qualify as an essential health benefit, but they could probably still limit the amount of times that you could go to the mental health provider. Though they can't limit the dollar amount, they can still limit the number of times you can go. And I know that's a bit complicated, but that's how it works. And that only works for small group. If you're a large employer, you're not subject to the essential health benefits to the extent you don't offer it. Yes?
I'm a small company with 32 people.
Mm-hmm.
And if we reduce some of them to 30 hours, and then they work overtime, say 25 hours, but they only do that 4 or 5 times a year, that person would be full-time?
Yeah, the question came in. She has a company under 50 full-time employees. They, in general, stay under 30 hours, but sometimes work overtime, would they qualify? And the answer is it would have to be on average over 30 hours a week to qualify for coverage. Now, if that person goes, again, that person going to the exchange, you are not subject to any penalty in any way, shape, and form for them going for exchange coverage at that under that 30-hour threshold. But it may require you to measure them to see if they are exchange eligible or not. Because the first issue is if they do qualify under your plan, then is your plan affordable and is it of minimum value? So, but you wouldn't be subject to a penalty. So, yes.
You said that there was a mandatory 90-day period to offer eligibility. But then if we have people who are on the fence, like this lady was talking about, you got to measure them a year from now. How does that reconcile?
Well, I mean, the question was regarding measuring people that are working variable hours because of the 90-day requirement under the law to put them on the plan. And it's an inconsistency. I mean, you could ostensibly measure me for a year. A lot of your variable hour people probably aren't going to last your measurement period. So, you know, in a lot of cases, it's a way for you to ferret out people getting on the plan that are then going to eventually just drop off. But yes, that's an inconsistency in the law. The idea is to put them on after 90 days, but you could extend it up to 13 months.
I did that too. Since rates are no longer based on the group, how are rates going to be determined?
Well, and again, it's going to be based on your age, whether or not you smoke, where you live, and how many people you're applying for coverage for. And there was one question regarding an independent contractor versus a W-2 employee, and I think that's a really good point. Is an independent contractor is not considered an employee under purposes of this law. However, you know that is an area where the IRS sometimes loves to come in, and maybe Walter could speak to that, but to say, you know what, you really should have this person on the payroll. So, but an independent contractor is not a W-2 employee, and you wouldn't have to consider them in your count for your FTEs.
Speaking about rates, as they compute rates, will people in Virginia have a different premium to pay than people in Florida, than people in Arizona?
Yeah, but yes, it's possible because they're going to divide the country up into like a rural area. Your rate's going to be less expensive than maybe New York, which is going to be a high rating area, that kind of thing. So yeah, that could come into play a little bit. Okay, and I just want to end with one last question. It says, what if two working employees neither have group insurance? Can the children get coverage through the exchange? Okay, well, in order to answer this question, you have to know, are the employees offered coverage? Are the parents being offered coverage? If they're being offered coverage, then if it's affordable and of minimum value, the dependents cannot go to the exchange. If the employees are not offered coverage, then everyone would be exchange eligible and possibly eligible for a tax credit. So.
And the children in the past, before the health reform bill came into effect, you used to be able to get a policy for a 20-year-old or a 16-year-old. The parents didn't need it. With the passage of the health reform bill, that was removed. If an employer does not offer coverage to the spouse or to the husband, either which way, or wife, whatever the case, and they only want their children to have coverage, can the children go to the exchange via the parents and get coverage?
Not if they're eligible under the parents' plan and the plan meets the affordability and minimum value.
There's no plans.
Oh.
No plans. The employer doesn't offer a plan in either case, so there is no health coverage being offered, but I want to make sure my children are insured.
Yeah, that's a question for the exchange. I mean, they're going to look at, when you qualify, when you go to the exchange, they're going to look at your household income. They're going to say, how many people do you have in your family? Who needs coverage? So the chances are you're probably not going to be able to, you're not going to be able to get coverage for one and not for the other, if I'm answering that correctly. Okay. All right. Well, I think that's it. I think you guys you should give yourselves a round of applause for making it through this. Thank you very much.
And
really appreciate it.
I want to thank you for all attending. I want to thank Corbin, Walter for their presentation. And Matt, we did a lot of effort in trying to make this somewhat non-boring to you. I haven't seen anybody pop the Tums yet, but I know you will. We're going to be here at Beskin Associates and Corbin afterwards for a while to answer any personal questions for anybody. And during the course, as I said, of the year, we're going to keep everybody abreast of what's going on. Thank you for attending.
Thank you.
Thank you.